Good afternoon. Good afternoon, welcome. Thank you for being here today for our CIPR Spring event. My name is Erin Campbell. I am the Regulatory Research Services Manager at CIPR. Happy to welcome you with us today. Just a couple of quick housekeeping items before we get started. We are offering DRC credit for this session today. There are sign-in sheets on your tables for our in-person folks. Please make sure to sign in if you want your credit. And you do have to be present for the full session if you want the credit. So if you need to step out, we have someone at the door to check you out and then back in again. So please do that. Our materials are posted on our CIPR website, and they're also in your interactive agenda. So take advantage of those. There's lots of good stuff in there, as well as bios for our presenters. And then finally, for Q&A, we'll be using Slido today. And so to join, you just scan the QR code, or you can go to slido.com and then enter CIPR. And from there, you can ask questions. Feel free to ask questions along the way, and we will cover as many as we can in our last segment. And so with that, I'm going to welcome my colleague, Jeff Sikowski, up to get us started.
Thank you, Erin, and thank you, everyone, for making it today to the event. I just had a few opening comments before I pass it over to the panel. So we're really excited to be hosting this as our Back to Basics, part of our Back to Basics series, as both a virtual webinar, but here for the first time as a live event at the spring meeting. Just some background for you if you aren't familiar with our Back to Basics webinar series. We've been co-hosting this for the past 3 years with the Griffith Foundation, represented by Frank Tomasello, who's going to be moderating today. And it's really been a great partnership. It's been very well received. It's really one of the cornerstones of what we like to think of as our CIPR core knowledge programming pieces. And so I'd really like to just give hats off to Frank and Erin, who organized those events. And just for your reference, some previous topics have been on captives, guarantee associations, climate resilience, surplus lines, and of course, somewhat related to a number of those today is a topic on residual markets for homeowners. Erin mentioned, the materials for today, and all the previous recordings on any of those Back to Basics are available on a link in the program or off of our CIPR website. And I would just point out a couple of other things in the program. We have other topics related to this. We have a CIPR insurance topic page on FAIR plans. If you're not familiar, we also have the Journal of Insurance Regulation as a part of CIPR, and we've published previous articles on residual markets in the JAR, and again, those are referenced in your program. We're going to sort of talk about PIPSO data today. We have a partnership with PIPSO for any regulators in the room. If you're interested in getting access to the PIPSO data, it is now available on our research library website. So you have access to that, which is another really great thing. And we've also been doing some of our own work in this space on residual markets, and there's a copy of a report that was released a few years ago in the guide. So just, again, kind of as a reference for you, please to continue to think about CIPR as you're thinking about insurance issues like residual markets. Feel free to reach out to connect with us. And for our regulators too, another shameless plug, we do have an NAIC Connect page that we started up, so if you'd like to join that as well. And with that, I am going to exit stage right here and hand it over to Dr. Charles Nice from Florida State University to get us started.
Thank you all for coming. Is there a clicker, Jeff? Slides? It's on the podium. So you want me at the podium then? No. No? I don't want to be at the podium. There we go. Thank you. All right. Should I cover this one? So the Griffith Foundation is an educational foundation and affiliate of the institutes. is a 503c3 not-for-profit, nonpartisan, and non-advocative educational organization dedicated to the teaching and study of insurance and risk management. So basically what our panel is going to do up here is we're going to try and be nonpartisan or non-advocative, just provide you with some information that's going on in the marketplace and how it relates to the basics that we're talking about today, residual markets and property insurance in general. So my name is Chuck Nice. I'm a faculty member down at Florida State University. I've been studying catastrophes for nearly 30 years. I went into graduate school right after Hurricane Andrew hit Florida in 1992. So the good news about catastrophes is they have a big effect on homeowners and how the markets work. So I'm going to provide you with a little bit of background about why we saw FAIR plans developed and why we see other types of residual markets, and then we're going to turn it over to some other experts in the panel. So one of the things I think it's important for people to understand is why do we care about how important residual markets are becoming, especially in property. And just a few trends that we see, and this has been going on for a long time, but just from 2024, the year that just finished, there were 27 different events in the United States that caused losses of more than $1 billion. This is not a localized problem. This isn't a California problem. It's not a Florida problem. This is something that we're seeing throughout the United States, across the plains, in the southeast, in the northeast, in the west. So this is what we have to kind of deal with as we work our way through talking about how things are going to develop over the next few years. CBS News reports economic losses are at one of their highest in almost 8 or 9 years. How does that relate to customers and consumers? J.D. Power says, hey, people aren't happy when their homeowners insurance premiums go up. It strains the relationship. And that's what we're seeing happening, right? 2023 was a really bad year for the industry. 2024 was better, but mainly because we saw rate increases happening. Now, here's the side part of that. I mentioned the word there, rate increases. And I know this is back to basics, so I'm going to point out the difference here between rate and premium or price. The consumer does not care whether rates go up or rates go down. They want to know how much they have to pay. And what is driving the out-of-pocket costs for insurance, especially property insurance, especially homeowners? And there's a few things. Number one is exposure growth. What we've seen over the last 30 years is more, well, we're heading toward 350 million Americans. Population is growing. We continue to build in places we hadn't built before. Certain parts of the country, and this is to some extent not going to be uniform across states. You will see that states like California, states like New York may be losing some people. States like Florida, states like Texas are gaining people. So there will be some much more state-by-state variation in that trend of exposure growth. But that drives price increases. Number two, inflation. 2021, 2022, and again, from a property insurance perspective, why do I care about inflation? It's the rebuilding cost. What is an insurer doing? They're rebuilding the home if damage occurs. 2021, 11.9% increase in residential building costs. 2022, 16.9%. Good news, 2023, 2024, relatively flat. But you take a 25% increase in construction costs, that gets folded into the cost for new construction. Again, not being partisan, not being political, tariffs will probably have an effect on this. If we are getting a substantial amount of lumber from Canada, and 60% of our building lumber looks like it comes from Canada, putting tariffs on that will drive up building costs. All of this means more higher rates, or higher, shouldn't say higher rates, higher premiums for those paying it. The word that I'm not allowed to talk about, climate change, so we changed it to climate risk, right? Climate risk, what's going on? The climate's changing. Yes, the climate's always been changing, it always is. Do we see more events? It certainly looks like we see more events. Are they worse, or is it just that people are in the way now? Is it better reporting? And my answer is, yeah, I think it's all of those things. I would argue what we've seen in Florida over the last 6 or 7 years, the number of storms that have started in the Gulf and stayed Gulf side and made landfall on the Gulf side, substantial. So those are the types of things that we worry about. And all of that leads to uncertainty. And from an insurance company's perspective, uncertainty means higher premiums. And then the last one up there, the cost of capital. I always used to think of homeowners insurance as something that was relatively stable. It was a relatively predictive line of insurance, relatively low profitability for insurance companies. I don't think that's the case anymore. If you look at the volatility of losses that we see in the homeowners line in a lot of states, what we're seeing is higher volatility leads to higher uncertainty. From an insurance company's perspective, that means they want more money, higher cost of capital to satisfy their investors if it's a higher risk line of business, right? All of these things drive insurance costs up, all right? So second part of this, that's the one side, the insurance side. Think about the consumer side of this for a minute. Roughly 60% of the people in the United States live in a primary residence that they own, right? So others are renters. How much is that house worth to them? What is the value? You know, typically for most households, that primary residence is the largest asset they hold, right? They need insurance, they need protection on that. Give you an idea of average equity in a house is about $175,000. You know, this is the next line should be the one that scares everybody in this room, right? The average amount of equity in a house is $175,000. The average household wealth with equity is $187,000. Most people don't have anything besides their home, right? That is their main source of savings. U.S. people on average, U.S. households save less than 3% a year on average. Everybody's relying on Social Security. So if you think about that, how many people out there are counting on their homes to be there when it comes time for the retirement plans? Insurance is vital. The cost of insurance is going up. Property insurance is vital to them. You know, we always talk about people having to buy insurance, and the short answer is they don't have to buy, well, unless their mortgage company requires it, right? And we have about 60% of the properties in the United States are mortgaged. And you're like, wow, that's 40% that have no mortgage. That's great. Well, that's actually the third lowest in most of the developed countries. You know, there's a lot of people in other countries that have a lot more, mortgage-free households. So we end up with something that is expensive, something that people really need, and something for a lot of people that's required, right? So what happens, right? And that's where we start talking about this idea of, the private market and public insurance or residual markets and fair plans and all these other kind of terms that we're going to throw at you now. So think about it this way. You have a product that we're going to require people to buy. Even if we don't require it, we want them to have it. They should have it. It's expensive. What if the private market doesn't want to provide it to them? What if there's something unique about their property they don't fit in with what we consider normal underwriting guidelines, right? And the answer is that's what the residual market's for. All right, now I'm going to throw some different terms at you here. So number one, the residual market. These are the people, and again, it could be property, it could be auto, it could be workers' compensation. These are the people that we're usually typically thinking about. It's a popular line of insurance. They have to have it or they want to have it, but something about them is not quite standard, right? So the whole point behind this, when the states develop things like a fair plan or they develop a residual market, is availability. We want to make sure that if you want coverage or if we're requiring coverage, it is available to you. And if you go back and look, and I don't care what line of business it is, you can go back and look at 100 years ago when states were dealing with workers' comp issues. And 100 years ago, states were dealing with workers' comp issues. We still have that popping up in states today. A bunch of states, what they did is they stood up their own workers' comp insurance company. And they said, okay, go operate as an insurer, and this is the way we're going to kind of regulate that market for you, right? To make sure it's available. Very little of what the states ever did historically to address insurance availability talked about affordability. It was always addressing the availability issue. So their coverages may have been a little bit different. Maybe they were a little less broad. We want to make sure you have some basic coverages available. It shows up in a variety of lines of businesses, residual markets. You're probably very familiar with the auto ones. You're probably more familiar with, some of you, depending on where you live, may be more familiar with the property ones. Workers' comp ones are great examples of this as well, right? And the idea behind it is the state's not going to be a competitor, right? We don't want to compete with the private market. We don't want to take their place. We want to provide for those who can't find what they need in the private market. And this is vastly different than what we would also consider a different line, the excess and surplus lines. So when we had a little talk about coming up here, and Frank says to me, like, make sure you talk about excess and surplus lines and the difference between that and residual markets. I said, well, I hope they understand the difference. I mean, these are our regulators, right? He's like, but there's new people in the crowd. So in Florida, excess and surplus lines, another name for that is the non-admitted market, right? So when we talk about something like homeowners, and our commissioner's up here, he'll be able to talk to you about all the companies that are admitted to do business in the standard homeowners market in the state of Florida. Well, 10 or 15% of our marketplace is what we call excess and surplus lines. These are the large insurance companies that are what we call non-admitted. They are still regulated by the state. They're just not as heavily regulated as the admitted companies. They're usually rated by the rating agencies like AM Best. And they also underwrite the households that are not quite standard. But their version of not quite standard would be a $30 million house on the beach, not one that doesn't really have heat, right? A little bit difference in the types of houses that are typically insured in that excess and surplus lines versus what ends up falling into the residual market. Excess and surplus lines, they are competitive. They will write policies that a normal homeowner will not write. Happens in all lines of business in Florida. We actually, a lot of the property stuff is specifically is in excess and surplus lines. Now, one of the things we want to talk about for residual markets is some of the distinctions we see state to state. So in a place like Florida, right, when we have something called a beach or windstorm plan, right? Well, we don't have that anymore. We actually had two different joint underwriting associations. One was our residual market, which is more like our FAIR plan, which is called Fair Access to Insurance Requirements. And the other one was our beach storm plan. They all got merged together and they formed a company called Citizens. Citizens is kind of unique. You hear a little bit more about it. Us in Louisiana are the only two that have Citizens companies up and running. But the FAIR plans and the beach and windstorm plans, these are what we traditionally consider our residual markets in property. So fair access to insurance requirements, where did it come from? Well, this actually came out of the 1950s, 1960s, and part of the civil rights era, where there were certain areas where some people did not want to sell. In banks, they called it redlining, right? In insurance, we have very similar problems. There were certain parts, especially in urban areas, where the companies did not want to underwrite. So fair access to insurance requirements, the idea was passed at federal level that each state was going to develop its own fair insurance company to underwrite risk in those states. And what we found is that there were a number of states who didn't have an issue. There was no need for a fair plan in some states. They didn't have urban issues that other states were running into. They didn't have high concentration urban areas to even worry about. So what happened is a number of states, and Stephen will talk a little bit more about it, the companies that actually did come up with fair plans, put them in place. And that is the access to insurance requirements. Now, what we're seeing, and this is what we're hearing from the rest of the panel, is these are tools that are sitting out there right now for regulators. We have a FAIR plan, we have a Citizens, we have a beach plan, and all of a sudden our constituents are worried about cost. What do we do to address cost in insurance and affordability? And they're looking at the tools we have, and they're trying to fit a square peg into a round hole. Right? These were not designed to address affordability. They were designed to address availability. And those are two very distinct concepts. I'm just going to finish with this before I turn things over to Stephen. When I teach a principles of insurance class, what do I teach people? I tell them that when an insurance company sets their rates, right, they should be equitable and fair, right? They should be risk-based, right? And they should be, they should distinguish between high risks and low risks. At no point do I ever say they should be affordable, right? Because what does the premium tell us? And what it tells us, it's a pricing of risk. What are insurance companies really good at? They price risk, and then they underwrite, and they make sure they identify who is the right risk and who gets charged what. When we start doing things at a public policy level that start to change that pricing, it changes the incentives. And that's something we have to worry about with these types of things. So that's my very brief history of how we got to where we are with residual markets. So you hear the term FAIR plans, beach and windstorm plans, residual markets, all that kind of fun stuff. That's how we got here. Stephen?
Thank you. Stephen, if you would, advance just one slide for a moment. I want to take a moment to remind folks both in the audience and folks participating remotely, you may ask questions. You may use the Slido app. To do that, you can scan the QR code or go to the slido.com site and enter code CIPR. I'm told that's not case sensitive. The final segment of our time together here will devote to Q&A, so we encourage questions and we'll cover as many as time permits. So I did want to mention that. Now, let me turn things over to Stephen Jablonski, who's the president of the Property Insurance Plan Service Office. We refer to that as PIPSO, to share his expertise on the residual market and the landscape today. Stephen, thanks.
Thank you very much for the introduction. As he just mentioned, I am the president of PIPSO. I'm the new president of PIPSO. And what an exciting time to be the new president of PIPSO. I appreciate the NAIC inviting us here, and I appreciate the partnership. And that's one of the things that PIPSO does is it works to foster partnerships and relationships with organizations that will provide benefit to the insurance buying public writ large, but also directly to the FAIR plans. So we'll talk a little bit about trends over the last 5 years. We'll talk a little bit about how we work with our plans. Sorry, I can't see which slide. Oh, okay. Okay, thank you very much, sorry. Talk a little bit about PIPSO, how we came about, what our purpose was, what sorts of things we do for the plans, and then a great introduction to FAIR plans. I'll go a little bit more into FAIR plan and beach plan structure. So we're starting off with the last 5 years, and the slide you see before you is policies issued over the course of the past 5 years. And we're starting off with about 1.8 million policies in 2019, and by 2023, we're up to about 3.3 million. And this is far and away the largest number of policies that have been issued by the plans on an annual basis. We are in the process of collecting and compiling the 2024 data. We expect that policy count to probably be neutral or maybe even go down a little bit. And you've heard a lot and seen a lot in the press about California, and they are one of the primary drivers of the policy count increase, along with Florida. And that's also driven, for the factors previously mentioned, the increase in housing costs, the increase in property values, the increase in reconstruction costs that has driven written premium, because a lot of the plans are providing coverage that needs to protect that mortgage. So it has to be for a higher amount than it previously was. So again, we start off in 2019 with about $2.5 billion. By 2023, we're up to $8.8 billion. Pretty dramatic increase. And we anticipate that 2024 premiums are going to exceed that. The same story plays out with exposure. So starting in 2019, we're starting with $495 billion, and as of 2023, we're at $1.3 trillion. So the plans really are in uncharted territory. They're bigger than they've ever been. That's not the intent. The intent is to provide basic property insurance. And of the plans that are out there, 17 of them write a homeowner's product. Of the 17 that write a homeowner's product, 8 of them write an HO3. Most of the policies written are under a DP policy, under the personal lines. When you look at aggregate policy counts, 98% plus of the policies written by the Fair and Beach plans are personal lines. Less than 2% are commercial. Under a commercial fire policy, the plans write a standard property policy, a form that was developed specifically for the Fair plans. If you know this vernacular, the old fire EC VMM, Group 1, Group 2, sprinkler leakage, and that's it. There's only a couple of plans, California being one, that writes a BOP, and they don't write very many of them. Again, kind of going over this 5-year period and looking at loss counts. They're not remarkable considering the amount of coverage that the plans are providing and the amount of policies that they're writing. There are a few spikes that correspond to events. Most notably in 2022, there's a spike for Hurricane Ian. And that hit Florida particularly hard. Also reflected in the paid losses, and you see that spike. And if you notice on most of these slides, there's an orange line on the bottom, and that's the beach plans. And the beach plans have not seen the amount of growth that the fair plans have. Because the fair plans offer broader coverage. That broader coverage is what's being requested by consumers in order to protect their resources and their assets. So PIPSO came about shortly after the advent of the plans. In 1970, PIPSO was part of the National Committee on Property Insurance. And we were part of that along with another organization called IPLR, IPPILR. And that was the Insurance Institute for Property Loss Reduction. You now know that organization by the initials IBHS. In 1985, IBHS went down the path of loss mitigation, and PIPSO continued to be a service office for the Fair and Beach plans. We provide the plans with a number of different resources. We produce reports for them. We do auditing of claims and underwriting for them. We provide educational conferences for them. And we also provide sort of a gathering point to share knowledge, best practices, and economies of scale. How we're able to exercise some of those is by organizing decreased fees for certain services. PIPSO buys a membership on behalf of all of the plans with IBHS at a vastly reduced rate. We do the same thing with APCIA. We also work with ISO-Verisk to help reduce fees for the Fair and Beach plans. All of the Fair and Beach plans are non or not-for-profit. And PIPSO follows in that line. We're a 501c6, a business league, and we are a not-for-profit. We encourage the fair plans to use PIPSO, and we also leverage our relationship with APSO, the auto insurance plans. PIPSO is a very small office. The resources mainly consist of our knowledge, the resources we have in-house, and the strength of our membership, the depth and breadth of their knowledge and their ability to assist one another, and for us to facilitate that. So we always encourage them to contact us first when they're undertaking a new initiative or a new program, because the chances are that one of their fellow Fair or Beach plans has probably done something similar and may be able to help them and not reinvent the wheel. They're all nonprofits. All of their resources are limited to a greater or lesser degree. And efficiency is really the key to PIPSO's mission in helping them operate efficiently and effectively. So to that end, we do research on their behalf. Some of the research we have is in-house. Some of it is as a result of the data that we collect from them on an annual basis. And some of it we just do ad hoc. We may survey our membership, we may survey other resources. We have a lot of historical information in-house. We have documents going back to the early 70s, back to the program bulletins where we developed underwriting manuals, claims manuals, auditing manuals, rating manuals. And all of these resources are still available to the plans. Some of them, albeit, are a little outdated, but the principles still remain. And there's something to build off of. And we are in the process, and we have a very small staff at PIPSO, but we are in the process of updating all of those works and manuals as we go along. We also produce annual publications. We produce a compendium of property insurance. The compendium of property insurance lists every FAIR plan. It includes a narrative that describes their operations. It includes vital statistics, which tells you about their operations, the lines of business that they write, their financial results over the past 5 years, their organization, whether they are a syndicate or act as with a servicing carrier. When the plans started, they were all servicing carriers. They were all sort of pass-throughs, and the paper was being written on their letterhead, but underwritten by other insurers. Over the course of time, they all became syndicates. They all operate as regular insurance companies for the most part, with the exception of not having a marketing department. Now, I went to work for the Massachusetts and Rhode Island FAIR plans in 1985, and one of the first things I was taught was that our purpose is to put ourselves out of business. And that hasn't happened. None of the FAIR plans have gone out of business. And in fact, a few of them are starting to grow. And as Commissioner Conway will speak to, we have the first new FAIR plan since 2002, when Texas, who already had a beach plan, implemented a FAIR plan. Prior to that, Hawaii, in response to Typhoon Inaki. Prior to that, you're going back to the 70s. So those publications, like the compendium, are purchased by insurance companies. They're used by our own membership. They're often purchased by reinsurers who want to know more and more detailed information about the plans. We also produce PIPSA reports, which is a statistical report of their results, including premiums earned, written, losses, and aggregate results, which is what you saw as part of that earlier slide presentation. Those are purchased. And I'll tell you, in 2024, we sold more PIPSO publications than we've sold since I've been at PIPSO, which is 2004. There's a lot of interest in the FAIR plans, and you're seeing that both from a public standpoint and also from a legislative standpoint. We've had more inquiries from both the federal government and state governments than we've ever had. Like I said, it's an exciting time to be the new president of PIPSO. So this slide, I'm going to talk a little bit about FAIR and beach plan structures. So you see the plans that are lit up there in red. Now, with the exception of Colorado, those are all FAIR and beach plans that went in place back in 1969 through 1971. And as was mentioned before, they were primarily put in place to address issues of availability, primarily in urban areas. And that was in response to the Watts riots and after the assassinations of JFK, RFK, and Martin Luther King. There was a serious availability issue in urban areas. And initially, the plan was that every state would have a FAIR plan. And as you know, plans or states are regulated pretty aggressively by their insurance departments, and a lot of states pushed back. and they said, we don't need a fair plan. We're not having an availability issue here in Wyoming. We're not having an availability issue here in Maine. So they limited it to 32 plans. Eventually, the availability issue shifted from urban areas to those states that you see denoted in orange. And those are the beach and wind plans. And that's where the availability really came to the fore. And right now, I mean, I have Florida as a red plan. They started out as a beach and wind plan. When Hurricane Andrew hit, they were a $24 million plan. After Hurricane Andrew hit, they were a $300 million plan. And the plans are designed specifically to scale up and scale down quickly and effectively in response to factors in the external environment. And they do that extremely well. California 10 years ago was $95 million. California in 2024 is going to be over $1.5 billion. The plans you see in green are plans where PIPSO has received inquiries as to the potential formation of FAIR plans. So that's Nevada, and you may have heard a little news about Nevada in the past day or two. Some legislation was introduced to potentially introduce a FAIR plan. Utah, Idaho, Montana, and South Dakota have also made inquiries. The few states that you see there in blue, there's been no inquiry or discussion of a FAIR plan. So in closing, I'd like to give you a few more stats. We as PIPSO see it as we serve at the pleasure of our membership. We're a service office, and we specifically do what they request us to do. There has been some discussion of PIPSO developing a public policy function, and I guess maybe I'm trying that out a little bit right now, and I appreciate your attention. But what PIPSO will not do is speak directly on behalf of any particular plan. Everyone likes to be in control of their own information and in control of their own message, and that is not PIPSO's role. Our role is to support the FAIR plans and help them operate effectively. I appreciate your attention, and I thank you for your attention.
Thank you, Stephen. Appreciate it. I think you've helped to paint a vivid picture of the current residual market, and also imparted some knowledge on the role and the resources of PIPSO, so we appreciate that. We have lots to cover and limited time to do so. What I'd like to do now is to seek some perspective through the regulatory lens. And joining us on the panel today are two regulatory thought leaders. We have Commissioner Michael Conway of the Colorado Division of Insurance, and seated next to him, Commissioner Michael Jaworski of the Florida Office of Insurance. We thank you both for being with us. Over the next 20 minutes or so, we'd welcome your perspectives. And I thought we might, if you're open to it, call upon you, Commissioner Conway, first to maybe kick things off and perhaps talk a bit about the work that has taken place in Colorado to build and to launch its FAIR plan. Perhaps you might share a bit about what led to development of the FAIR plan, and tell us, if you would, a little bit about what went into really building and launching that. Thereafter, we'll then call upon you, Commissioner Jaworski, if you'd like.
Hi, folks. I don't have slides because it makes it too hard for me to ramble if I have slides. I'm too controlled. So you're just going to have to listen to me talk, and please don't go to the next slide because I really don't want to have to look at a picture of myself. We're setting up a FAIR plan. So why are we setting up a FAIR plan? So about probably 4 or 5 years ago, we started getting more and more phone calls from a variety of actors within Colorado about the challenges that were impacting the market. But in particular, we started to hear more and more from our independent agents. And I know independent agents, right, that we all hear from independent agents about a variety of different issues. But what they started to really sound the alarm about was the fact that they couldn't find coverage for people in certain pockets of the state. At that point, it wasn't accurate that they couldn't find coverage for folks, but it was certainly getting tighter. And we were hearing that from a number of different sources. In Colorado, we've got two things that challenge us. We have hail and we have wildfire. Hail causes availability issues because it puts strain on the capacity of insurance companies to take on risk in our state. But where we truly have the availability issues are in our wildfire areas of the state. So up into the mountain areas, along the WUI, and in certain places as well. So, but we knew that we were going to have a better story to tell than just the fact that I had gotten some phone calls from some independent agents that were nervous about life. So we went down the path of doing a study to see what was happening in our market. We performed that study in 2022, and what the study effectively showed was that the market was concentrating. The market was concentrating. We didn't have availability issues still at that point, but the market was concentrating into really our top 5 biggest insurers in the state. And what we were then able to show, to go and have a conversation with the legislature, really about 2 things. One, the market was concentrating. And if we have one of those insurance companies decide that they also want to pull back from some of our more treacherous parts of the state, we were going to have a real availability crisis on our hands. And then the second piece, we just had an honest conversation that these things aren't easy to stand up, right? As these folks touched on, we're the first state in at least 20 years, if you don't include Texas, we're the first state in closer to 30 or 40 years to set up a FAIR plan. Nobody knew how the hell to do this, candidly, right? Because it just hadn't been done in such a long period of time. So we were honest that it was going to take us at least 2 years from our vantage point, from the point when the legislation was actually passed to the point where it was at least likely that we were going to have policies in force and in play out there. And if we, in that period of time, if we started to develop an availability issue and or we waited for the availability issue to actually come to Colorado, it was going to be too late for folks, right? We were going to have places within the state where those availability issues started to have real world impacts on the real estate market and the ability for people to buy and sell homes. That is starting to happen right now in Colorado. Right? We have challenges in little tiny pockets in Colorado where the real estate market is challenged because of the inability for people to find insurance coverage when they're going to purchase the home. The people aren't necessarily getting non-renewed by their existing insurance company, but we do have places where new businesses become a challenge. So that's why we went down the path of the FAIR plan, right? We saw the problem coming our way. We convinced the legislature, we convinced the governor that we really needed to get in front of that problem before it became a crisis, because by the time it became a crisis, it was going to be too late. But we were also very, very clear throughout the conversation that the FAIR plan could not and was not going to be a solution to our affordability challenges in the state. We have significant affordability challenges in the state. We've seen premium increases over the last 4 to 5 years of nearly 90%. I do fundamentally believe that it is part of my job, it's part of our job at the division to find solutions for the affordability challenges that we have in the state. But the FAIR plan can't be that, right? And we were very clear with the legislature that the FAIR plan can't be the solution for affordability because of the structure of the FAIR plan, right? We haven't talked about it up to this point, but for all intents and purposes, the reserve mechanism for the FAIR plan, at least the way that we've built the FAIR plan, is the rest of the admitted market. So if we have the FAIR plan directly competing with the admitted market and taking business away from the admitted market in a big substantive way, we're going to have a challenge if that FAIR plan one gets too big, and then we have to have some sort of an assessment in order to pay claims. If we don't have that admitted market, the whole thing doesn't work. It starts to crumble. But we were also, like I said, very clear that this was step one. It was always part of the game plan that we were going to address the availability issue that we have in the state, or the potential for an availability issue. But I was very clear when those conversations were happening that we were going to come in the future with affordability solutions too. And we're doing that now, and happy to get into that if time allows. But I think the other component, just to highlight for folks, that we specifically built into our FAIR Plan, or a couple components that we built into our FAIR Plan, again, to control or attempt to control for the FAIR Plan getting too big, are the limits that are in place. So we have, for the personal line single-family home limit is $750,000. That's all in, folks. It's a DP1 policy, so that is for the entire coverage, $750,000. That ain't going to go very far, right? And we know that, and so as part of the conversation, when the legislation was working its way through, I was again really clear with our legislators, but also the industry, or at least we attempted to be really clear, that the industry had the ability to control whether or not that $750,000 cap actually stayed at $750,000 or if it increased. And what we meant by that was that if the industry truly wanted to keep that $750,000 cap in place, they were going to have to come to the table with difference in condition policies so that we could wrap policies, we could stack policies on top of that DP1 so people could get some level of coverage that they would at least feel reasonably assured that was going to give them enough coverage if they did lose their home. That's been a little bit slow, candidly. We've got one filing in place for the DP1, or for a difference in conditions policy. I still anticipate that there's going to be more, but if there aren't more, I think you're going to hear legislators start to have conversations in Colorado about increasing those limits. I don't think that's a good thing, right? From my vantage point, I don't think it's a good thing if the market doesn't respond in the way that we want it to respond and we have the ability to put robust coverages together. The other cap that we have in place, so that our FAIR Plan is going to have a commercial product as well, or does have a commercial product that will be coming to market later this year. That cap is $5 million for the commercial market. Our commercial market is particularly challenged, again, up into the mountain areas of the state with the HOA side of the business. So I think it will be interesting and somewhat fascinating to see what level of coverage people really are trying to go to with the FAIR Plan on the commercial side. But it won't be a solution for their affordability challenges there, and they're going to have to stack coverages in the commercial market as well. The last piece that I think is important from a building kind of standpoint, for at least for our FAIR Plan, in particular, again, with the ultimate intent being that we want this to be an insurer of last resort, but we do not want it to be something that's competing with the admitted market. Folks do have to get 3 denials from the admitted market before they're eligible for the FAIR Plan. So those are the core building blocks that we've put together. The FAIR Plan moved exceptionally fast, if I'm being fair to them. They're going to start quoting policies this month. They actually may have already started quoting policies this month with at least what we hope will be the fact that they'll have policies in place within a month or two, which will be right in time, candidly, for kind of those market challenges that we thought were going to be coming actually being present in Colorado. So we got in front of the problem. And we're happy that we got in front of the problem because I think we would be in an exceptionally difficult spot if we hadn't started this work 2 years ago. Michael?
Commissioner, thank you. Commissioner Jaworski, before we jump in here, just a quick reminder, slido.com is the site you'd want to go to if you wish to submit any questions for our panel. We have a Q&A segment forthcoming, and you would enter the code CIPR. That would allow you to submit a question. So we'd invite you to do that, both folks here in the room and folks joining us remotely. Commissioner Jaworski, your home state of Florida's FAIR Plan, Citizens Property Insurance Corporation. Professor Nice talked about it a little bit earlier. Perhaps you can share some insight with us there. A depopulation program authorized by the Florida legislature is underway in Florida. What can you tell us there? We welcome your thoughts.
You know, it's such an interesting discussion to have about FAIR Plans, residual markets, and those things, and then watch what the state of Florida has done over the past several decades now to address affordability and availability and reliability within its marketplace. And when you look at Citizens as just one example of a long-term strategy to address that, what you see is, I think, a bit of a difference from most other states, maybe with the exception of our good neighbors to the west in Louisiana, where there is a tacit acknowledgement that it's not an entity that is ever going to go away. It is a permanent fixture within our marketplace. Its goal is not necessarily, although language can change and one legislature to the next can change, the overall dynamic is there's a recognition that something like a Citizens will always exist and play a major role within our marketplace. And what we've seen most recently is a very stressed market between about 2017 to about 2023, where the current structure was tested in ways probably it has never been tested before, due to a confluence of human activity in social inflation, litigation, waste, fraud, and abuse, combined with a significant uptick in natural catastrophes, hurricanes, other events, and then both of those kind of ringing on a reinsurance cost bell that just quickly raised the cost of insurance quite dramatically, and the availability and affordability of insurance quite dramatically within the bounds of the state. And so we had Citizens, just to take back a little bit of time, we had Citizens in 2015, had about 420,000 policies within it. And by 2023, Citizens had grown to 1.4 million policyholders. And I think that graph earlier really depicts very well the environment that existed then. And so it grew rapidly. What did it have on hand to grow rapidly during that time period? It had gathered about $8.9 billion in surplus to manage a potential wave or influx in the increased number of policyholders that would need to reside within that pool. And we saw that act remarkably resilient, even with the social inflation challenges we saw that came about, natural catastrophes that came about, the cost of reinsurance that came about. It ended this journey in 2023 with about $3.5 billion still standing, with no need for an assessment. Post a lot of reforms that have taken place in 2022 and 2023 that changed a lot of the structure, it addressed a lot of social inflation dynamic challenges, but it also addressed a number of other factors just related to the structure of the way insurance exists in Florida. We see what's happening now as it was designed to grow rapidly, it's designed to shrink rapidly. And so we've gone from about 1.4 million policyholders in 2022. We're now down to about 800,000, with an expectation that will continue. That's both through an organic process as people interact with their agents, as well as the state's depopulation process that is a takeout, what we call commonly a takeout. We're trying to think of a new name because it sounds like we're just killing people, but it is a process by which we pull policies out in bulk and give companies an opportunity to do that. So far this year, the office has approved more takeouts probably in a year than it has in the past 3 years, and so we monitor that as it goes. But I think there has to be recognition in most of these markets that a residual market of some kind will always exist. In Florida, we'll see where the bottom of the barrel is this time. I think it's going to be quite north of 420,000, and that will present opportunities and challenges for Florida to kind of think about what it needs to do in the coming decades to meet the moments that we will have. But the overall dynamic is we're seeing a moment where Florida's market was tested in ways that it never has been before. It's recovered through reforms and other dynamics, and we're at a point now where other companies are entering en masse to take those policies or to just organically grow in the state, and rate adequacy seems to exist in the state with, I think we had a 1% average increase last year in the state of Florida for insurance. And so we're feeling very good about where we're going, but as a residual market, it's never going to go away in Florida. And as we approach a phase where we're getting 1,800 new residents a day, or I think a weekday, it doesn't really matter, it's just confounding to me. 1,800 new people on the road a day in that period. A lot of them, there's no place in Florida that is further than 70 miles away from a beach. And it's a challenging place and I think we might talk about some other mitigation and other things if we get into it, but it's a challenging environment to get any company to write almost anywhere. You've got to make sure that everything else is working well, and we just use Citizens as an integral part of that overall framework. And with that, I'll wrap to wherever we want to go.
Wonderful, thank you. Appreciate it, Commissioner. We have a variety of questions I see before us on our monitor. They also appear to be rapidly rolling on our screen. I'm not sure if there's a way for us to perhaps look at those in chronological order. But in the time that remains, let's jump into Q&A, and we thank folks for their questions. To begin the conversation, mostly today we've talked of homeowners and personal lines, but residual markets also exist on the commercial side, as Commissioner Conway briefly referenced. I'm curious, and this goes to all panelists, any interesting trends to note on the commercial side?
On commercial, commercial, we do, Citizens does have a small book that it's always maintained. We haven't seen a ton of movement in that space. Commercial residential has been especially interesting. We're seeing just like the takeout in the primary homeowners and other spaces, we're seeing tremendous takeout energy in the commercial residential space. That area in Florida in particular was challenged not only with all the other environments that we had, but then we also had the tragedy at Surfside, where you had a building unexpectedly collapse. And uncertainty is anathema to insurance. And so when you have that event happen, it sent an additional shockwave throughout that industry. And we're seeing that market recover as well, and we're seeing great takeout energy. But it's something to think about, that whole entire envelope of offering insurance products long term.
Thank you, Commissioner. Any additional color from any other panelists there?
I think it's too early for us to know what it's going to look like for us on the commercial side. As I alluded to, there are challenges in our market on the commercial side. The surplus lines market is effectively taken over that market in lots of places in the state. So how exactly the FAIR Plan will kind of stack up next to the surplus lines market will be interesting, but it'll be something that we're closely watching.
Thank you, Commissioner. Stephen? Chuck?
Well, just in regards to commercial, as I mentioned earlier, less than 2% of the plan's writings are on the commercial side. And as long as that degree of restriction in the coverage that's available is the norm amongst the plans, I don't think it's likely that you're going to see significant growth in FAIR Plan commercial book of business when there are other alternatives available like E&S.
Yeah, from a historical perspective, I think the advantage that a lot of the commercial space has is that they're able to pass those costs on to their consumers a lot easier. So if premiums are going up on your business owner's policy, you can adjust your product prices to match. Makes it a lot easier to do those pass-throughs. And a lot of the commercial stuff ends up in the excess and surplus lines as well, where the companies are more willing to take some of that risk.
Thank you, panelists. We have a question submitted asking, during the recent California wildfires, there was much conjecture in the press on the solvency of the California FAIR Plan. And our attendee asks, who assesses the solvency of residual markets? Perhaps we start deeply to my right and ask our two commissioners to kick things off there.
So in Florida, the structure is very much so like an insurance company. It is regulated by the office, and it is actually subjected to probably more regulatory scrutiny than any other entity, perhaps in the country. It is extraordinarily regulated. There's additional requirements around Citizens. And so when it comes to solvency, it's a bit different because it's an insurer that can never go out of business. It can never become insolvent structurally. It's more capitalized today than 94% of the insurance companies in the country on a per policyholder basis, but it has that vast pool of additional assessment authority that could be triggered when needed. Whether or not that assessment trigger was ever pulled, if there was an insolvency or there'd be some sort of general revenue type activity, is a good question that I hope we never have to answer. But the bottom line is that it's a very highly regulated entity in Florida.
Yeah, so we're in the same boat. I think as we develop our regulatory kind of muscle and kind of background when it comes to the FAIR Plan, we'll look to states like Florida and others that have had FAIR Plans out there for a while. But we are their primary regulator, their only regulator. And I think Mike's comments though about the solvency component are obviously incredibly key to keep in mind when we're talking about FAIR Plans. Right, we want their rates to be adequate. Their rates are going to be adequate, but because of the underlying risk that we're talking about, there is a potential, if the FAIR Plan gets big, that there could be what we would think of as this quote-unquote solvency issue for the FAIR Plan, but it's not a solvency issue like we have with other insurance companies, because it can't fail. Right? We have the ability, they have the ability to assess the market to make sure that that doesn't happen. But that's why it's so, from my vantage point, why it's so vitally important for us to be having a conversation in lockstep with the FAIR Plan conversation about how we drive affordability in our markets, so that we can keep people in the admitted market, so that we can encourage the admitted market to be robust in our states and competitive as well. So that is where we are headed.
Thank you, Commissioners. Steve and Chuck, anything you wish to add there?
Well, just in terms of the structure of the FAIR Plans, most of the FAIR Plans being associations, when an insurer does business in that state, they're required to be a member of that association and participate in the association to the extent that they participate in the market, both in profits and in losses. And one thing that doesn't get discussed very often is that on occasion, plans also make distributions to the plans in proportion to their market share, to their member companies.
Thank you, Stephen. Chuck?
Has Citizens ever paid? I don't think they. No, they. One of the things you talk about what we consider a market failure or insolvency for a Citizens, and you're right. It's some kind of assessment that occurs. It goes to the insurance companies. Many of the insurance companies, especially in Florida, for example, pass that through to the policyholders. The assessment gets passed through to policyholders. So we may not consider it an insolvency, but from an academic point of view, I always talk about what we call post-loss financing. The idea that we are going to fund an event after the fact by doing assessments on current policyholders and potentially future policyholders. And that is a real concern for operating these types of plans. When the government starts to dip their toe in to selling insurance, underwriting insurance, what is that backstop? And what is going to happen to if we have to do an assessment? We've had assessments in Florida. We had them after the 2004-2005 storms, where Citizens and the CAT Fund had assessments that were done. I know this because I moved to Florida in 2009. And when I bought my first house, I had an assessment on my homeowner's policy, my auto policy, my umbrella policy, all for losses that occurred in 2004 and 2005, when I didn't even live in Florida at the time. And now they were small, but this is one of the dangers of these types of approaches, this idea that you could push some of the cost onto future generations. So you have to be very careful about how we structure these plans and how we utilize that tool if it's something that we're trying to address with like an affordability issue.
Thank you, panelists. I want to shift gears. We have a question submitted asking, and we'll direct this directly to you, Stephen. Has PIPSO considered placing reinsurance collectively for plans?
Yes.
So, very succinct.
PIPSO has considered just about everything at one point or another on behalf of the plans. There are 11 plans that purchase reinsurance. 11 of the Fair and Beach plans purchase reinsurance. And the terms and conditions under which they do so vary to a large enough degree that they're more efficiently negotiated by the individual plans. PIPSO has worked to put together a program for facultative reinsurance for some of the smaller plans, because we're starting to see growth in some commercial risk in some of the smaller plans. And one attempt was successful and one attempt was unsuccessful. And there's not many plans that are buying facultative reinsurance. It's really just for the peace of mind of the plan director, so they can get a good night's sleep when they have $18 million risks on their books and bringing in $3 million a year in direct written premium.
Thank you, Stephen.
Sure.
A bit earlier during our time together, Chuck, you talked a little bit about and distinguished the excess and surplus lines market from the residual market. And we have an attendee who asks how the growth of the E&S market compares to market growth on the residual side. Welcome your thoughts there.
Yeah, it's an equal reaction. Whenever we see, and again, both the E&S market and the residual market, I think the way to think about them is pressure release valves. So when something's not functioning in your normal admitted market, what happens? And that could be, that the companies don't want to write as much, or we're not seeing new policies written. We're only seeing companies renewing, not issuing new policies. Any kind of growth, then it happens on both sides. We see growth on the bottom side on the residual market typically for the lower price properties. It's the higher price properties that tend to go to the E&S market on the homeowner side. There's a little bit more appetite for those to occur. And then when we see the private market start to function better, we see those kind of decline a little bit. But I will tell you, the residual markets adjust faster than the E&S markets do with regard to shrinking back down. Commissioner Jaworski kind of hinted at this a little bit earlier. The residual market in Florida, Citizens, they were up to 1.4 million policyholders in 2011. It wasn't until 2018 or 19 or 17 when they got back down to 400,000. We saw a huge expansion in the E&S market too in 2009, 2010. They didn't come back down as much. They stayed larger. And then when we saw the expansion of Citizens in 2019, 20, 21, 22, the E&S market grew again. And now Citizens is shrinking much more quicker than the E&S market is.
Thank you, Chuck. Any other color there?
I think it's just been an interesting phenomenon in Florida, particularly when we look at that, and that even during this crisis period, the admitted market also grew during the entire time period. And so you've got an interesting dynamic where the admitted market's growing, also the E&S market is growing a bit, and then you have Citizens, which obviously ballooned a great bit, a dramatic amount. And then so you have this odd phenomenon, and maybe it's growth or maybe it's something else, where you have, even with the conditions that were on the ground, and we have particular companies that we look at that were writing during that time period, it's just an interesting phenomenon about that interplay that exists. It really, as Chuck said, really pressure relief valves, and they're crucial to any marketplace as it's going through change.
Thank you. Any other comments there? Okay. Question to direct to the commissioners here. Each state has unique market characteristics and challenges. Commissioners, I'm curious, are there some insights or some lessons that you've learned from other jurisdictions, and care to share anything there with us?
Are we on the comparable coverage? Or is that just a more general?
I think just a more general.
Okay.
So I mean, from our vantage point, we certainly, as we were building it out and we were having discussions with the industry and with stakeholders just in general, there was obviously the lessons that were quote unquote learned out there that we wanted to try and find ways to make it so that the FAIR Plan wasn't competing with the admitted market. We wanted to find ways to help control the size of the FAIR Plan as well. So those lessons were at the forefront of a lot of the conversations. We didn't obviously agree with the industry on a lot of those components, but we found ways to compromise to make sure that we were getting the legislation through. And then, like I said, we really emphasized the concept that the industry had the ability to control where the FAIR Plan went from there, right? The industry has the ability to control the size of the FAIR Plan in many ways, and has the ability to control whether the FAIR Plan, whether those limits that we talked about before are going to be increased as time moves forward. But so I think from a general perspective, yes, there were lots of lessons learned. Whether we agreed with the lessons that were discussed as being learned was a different animal to some degree.
I think that's right. I think it just speaks more generally to the strength of the state-based system of regulation, and that you have so many unique markets with so many unique needs. And then when you get to the sub-part of a residual market, you want that flexibility to create something that is meeting your market, meeting your population, and providing coverage at the end of the day to people who need it.
Thank you, gentlemen. Appreciate your thoughts there. We have an attendee who asks, are FAIR Plans providing enough coverage? We welcome your thoughts on that as well, and I'm not sure who'd like to take that first.
I think it. I'm happy to. I think it just, and I saw that, and I was like, we got to answer that. That's a great question. The overall dynamic, I think you see with Citizens at least, and it depends on the FAIR Plan, and again, probably what the state need is. But with Citizens, what you're providing is truly comprehensive coverage for every consumer that is part of that plan. And for a mandatory takeout scenario, you have to provide comparable coverage, even if it's all different than what the company typically provides, to ensure that that same continuity is met. And so there's a lot of laws around that in every state, whether ACV versus RCV and other things that may play into that. But and I see, especially on commercial property, that one's a little more flexible in our space, at least, because it's expected that commercial property has a sophistication that your typical consumer lacks. But the overall dynamic at play, I think, is that, at least in Florida, and I'm sure a lot of other states, they're balancing out the affordability, the availability of the product in the private marketplace, providing that minimum coverage to get people what they absolutely need.
Yeah, I think from my vantage point, to some degree, it depends upon how you define enough coverage, right? There is absolutely going to be cases in Colorado where the $750,000 is not enough coverage to replace the home if the home is lost. But the flip side of that equation is that for those homes, the FAIR Plan very well may be the only thing that is available to them. So that's going to be enough coverage from that vantage point, but there's also going to be a very real need, and we talked about it, that we need those difference in condition policies to come into play in Colorado like they have in a lot of states. If that doesn't happen, like I know I keep repeating myself here, but if that doesn't happen, then it will be the case that those rates go up, or those limits go up, I should say, and the rates for that matter too. And that enough coverage definition will change along with it. But right, from the vantage point of there not being another solution out there for those folks, it's going to end up being enough coverage because it's going to be what they can get.
Thank you. Stephen, Chuck, any thoughts?
I think it's a pretty open-ended question in terms of what is enough coverage. I'm sure you would have plenty of people argue who are unable to obtain the coverage that they want through the FAIR Plan, that they're not offering enough. But I think, to Commissioner Conway's point, sometimes the FAIR Plan is sort of the only game in town for a particular property, given its characteristics. And I think it's important that they exist in order to meet that need.
Thank you, Stephen. Sure. Chuck?
Yeah, I think Stephen said earlier, there's only 8 states that sold HO3 policies in those plans. So from my perspective, I think it's incentives work. I don't think we want to incentivize people to go into these plans, right? So we want to put as much stuff in place that incentivizes them to have their homes prepared for private market, right? Whether that's maintenance of the home, or whatever the reason why the private market does not want to provide coverage. So I really do believe we want to make sure that these FAIR Plans are offering some minimal coverages that should be okay, but not to incentivize people as I just want the state to be my provider of insurance. Those kind of perverse incentives, can lead to socialization of the marketplace.
Thank you, Chuck. I'm going to go right back to you, Chuck, with our next question, which asks, and perhaps you can provide a little bit of a deeper dive here, how are rates generally set in the residual market?
Yeah. So residual markets, they vary from state to state, obviously. In many states, what you'll see is that it's in the creation of the plan how they're going to set rates. So it could be a survey of the top 20 or 25 writers in the state, and it's some multiple of what they charge, 1.1, 1.2, a 10% over, 20% over what the market charges. One way it's done. Others, the way Citizens does things in Florida. And again, I don't want to make this just a Florida-only conversation, but Florida and Louisiana, in Florida, we set rates based on them actually going through the actuarial process and determining what the rates should be, just like a regular insurance company would. But often you'd have to refer back to their creative legislation to see how the rates were determined to be set in that state. But the idea, again, from formation, they're not supposed to be competitors.
Yeah, so we did not. There was a push from the industry to have a 10% or 20% bump when our FAIR plan was going through, and we pushed back on that and didn't agree to it from the basic standpoint that we absolutely agreed that the rates have to be actuarially justified. And when you factor in the fact that the rates that were going to be charged for these folks were going to reflect that they were the highest risk in the state, the rates were going to be high, right? There wasn't going to be the case that they were going to be competing against the admitted market because the admitted market wasn't there. So from the vantage point of just kind of a common sense kind of construct, it didn't make any sense to us why we would have a 10% or a 20% bump when you have those other factors in play, right? It seemed like we would just be penalizing folks because they couldn't get coverage through the admitted market, and that didn't seem appropriate to us. So we really stressed the fact that the rates have to be actuarially justified, but we don't have a 10 or 20% bump.
Thank you, Commissioner. Other thoughts? Commissioner Jaworski, do you have something?
I think in a broader sense, looking at Florida's citizen statute, it's actually a really good exemplar of the dangers and perils of government getting too directly involved in insurance. When we look at it, and Citizens is a good program, it's done a lot of good over the years, but when we look at from the position of the regulator trying to implement the statute, we see this wild swashbuckling that's taken place over the years of affordability versus shrinking it down to being truly residual. And so it winds up being this a confluence of factors that are to be considered. We have a glide path about how rates have to be actuarially sound, but they're on a glide path. We have even with the glide path, you have to do a competitive analysis, and it's not clear if a competitive analysis is accurate. And so what I think it's really resultant from is the legislature will generally take some action to go in one way or the direction or the other, go towards it's not an affordability plan, it is solely a residual market plan, and then there'll be feedback from the people around that'll come back the next year saying, why did we ever do this? Why are you making Citizens more expensive? And they'll pass some new law that goes in the other direction. I think it's an interesting. These are great tools, but they can be politicized and cause challenges that maybe exceed what the framers thought was appropriate.
Thank you. Any color to add there? Other panelists, anything?
Well, having listened to many of the FAIR plans telling about their process of submitting rates for regulation or for approval, they do a good job of putting together a comprehensive proposal to rationalize and justify the rate that they're requesting. But whether or not that rate gets approved is subject to other factors. It's not necessarily, the plans are not file and use. They need approval from the Division of Insurance, they need approval from their department and from their board of directors in terms of the direction that they take with rates.
Chuck, anything to add?
No, I started with that one.
So looking ahead, I'm curious, what are some potential areas for future innovation or collaboration here? I want to step back a pace or two and welcome the panel's thoughts on that.
Well, just briefly, when I was learning about the plans, I was told these are not the market leaders. These are not the plans that are out front. These are not they're not the early adopters of technology. But since I've been involved in the plans, things have changed a lot in terms of the accessibility and availability of technology. And so the barriers to entry of being able to use technology and big data, and that's been discussed quite a bit during this conference, has improved for the plans. And I think that's to their benefit. I think it's to everyone's benefit. And that's one way in which I think the plans have changed over the years, and I think it's a benefit to the industry writ large and also to the plans.
So from my vantage point, the innovation discussion needs to focus on the affordability, or at least one of the places that it should focus is on the affordability side of the equation. Because I do fundamentally believe that if we can build more affordability into our homeowners insurance market, it will decrease the pressure on our FAIR plans around the country. But I think that innovation, when it comes to affordability, for some of the reasons that have been touched on today, they have to still be market-based solutions to the greatest extent possible. So, right, we've got, like I said at the beginning, we have two challenges in Colorado. We have hail and we have wildfire. So we're going to build out, and that, like I said, that the hail issue really does have an impact on our availability because of the capacity strain that it puts on our admitted carriers. So we're running a bill this session to do two things. One, to set up a Strength in Colorado program similar to what a number of other states have done. Florida has done it. A number of the Gulf states have done it. Minnesota has passed a law. Really designed for us, we're going to be designed to fortify roofs against hail along the Front Range and then into eastern Colorado, because we fundamentally believe that, like I said, if we can start to change the claim trajectory from hail, it will grow the capacity of our admitted market and incentivize them in those ways to at least have the ability to go back into the higher wildfire areas of the state. And that's the second piece of the bill. The second piece of the bill, we're going to set up a wildfire catastrophe program that really is going to act as a reinsurance mechanism for our market to, again, incentivize them if the admitted carriers want to participate in that reinsurance mechanism. They'll have to agree to write a certain portion of their business in the higher wildfire areas of the state. We think we can put this all together in a way that really does decrease the amount of pressure that the FAIR Plan would be under without these mechanisms in place. So we're hopeful that this is going to truly stabilize our market and start to reverse the trends that we've seen, both from an affordability but also an availability lens, and we're excited about it. So flash forward 2 months from now, and I'll tell you if we get it passed.
Thank you, Commissioner. Other thoughts?
I think that I agree wholeheartedly. I think it's one of the things I try to pound into the legislature back home is that the depopulation of citizens is a sign of a healthy market. It's not the cause of one. It is a tool that we have to manage unique circumstances within the state of Florida. And you've got to combine that with a host of other things as part of a long-term plan to address insurance affordability and availability within your state. And the one thing I often highlight to them back home is that, imagine where Florida would be, for all the challenges it has today with insurance, imagine where it would be 2 decades ago if it hadn't made those hard decisions to upgrade its building code, to make it mandatory for mitigation credits to come about, to encourage that hardening within the state. And now, what would that insurable market look like had we not taken those steps decades ago? And you've got a residual market. It's a bit of a pressure release valve along with some other things that are in there. But ultimately, you can't rely on that for long-term market success.
Yeah, I would argue that, and we already have it, right? So the question came flying by earlier about public-private partnerships. We already have public-private partnerships. I mean, Colorado standing up a FAIR Plan is not the state just deciding to do it on their own. That this is in conjunction with what's going on in the private market. When you start talking about offering layers of reinsurance, that public-private partnership, I think, is going to be vital to the success going forward. Where should governments be involved in insurance, and how should they be involved? Are questions that have to be answered. Commissioner Jaworski talked about this. We will be up here 50 years from now talking about this if we don't figure out ways of reducing future losses. Right? So it is great job security for me. I started doing this in 1992 with Hurricane Andrew, and this is not a joke. I actually was commissioned this year to do a study about what we should do about property insurance in the state of Florida by an organization, and part of the report I gave them was an excerpt from a report they commissioned in 1995 that said this is what the state of Florida needs to do, and I'm like, these all still apply today. And that was 30 years ago. If we hadn't hardened homes, but we had some of the toughest building codes in the country, they can be better, right? We have to go back and do something about the homes that are already existing, things that were built in the 70s, 80s, and early 90s, because they last 50, 60, 80 years. If we don't change that risk profile, these things aren't going to matter. Insured values are going to continue to grow. Private markets are going to have a tough time insuring them. Catastrophes are going to occur, and we'll still be talking about it.
Thank you, Chuck. We are nearly out of
Can we
time.
answer that question? Why should taxpayers who live in non-high-risk areas be asked to subsidize households that aren't?
Yes, please.
Because I just don't think it's correct, folks, for a number of different reasons. So just to read the full question, why should taxpayers who live in non-high-risk areas be asked to subsidize households living in high-risk areas who cannot get market homeowners insurance? So for a variety of reasons, I don't think the premise of the question is correct, but the two primary ones from my vantage point, for Colorado at the very least, is that these issues came to these homeowners in those quote-unquote high-risk areas. This is a new phenomenon in Colorado over the last 4 to 5 years where people can't or are having a harder time finding coverage. So it's not like a number of these people, the vast majority of these people, when they bought their homes 10, 20, 30 years ago, knew that this was going to be an issue and they were going into something and doing something that's kind of implicitly inappropriate by buying a home in those areas. But the other component, right, so there's the victim shaming aspect of it that I just don't agree with, but then there's also the component of the premise kind of assumes that our markets aren't our markets as a whole, right? If you have places in your state where the real estate market has collapsed, it isn't going to stay constrained in those places, right? It is going to grow beyond that. It's going to cause challenges for the state as a whole. So from my vantage point, those are the two primary reasons, but I just don't think it's an accurate statement to say that these low-risk folks are subsidizing in some way the high-risk parts of your state. The state is a state, right? And you've got to look at it from that vantage point. Your market is your market. So you have to figure out ways to make sure that your market is robust and has the ability to absorb the challenges that are out there. And if we start kind of picking and choosing which parts of your state that you are going to help, then it becomes really problematic really fast.
I think that's a great question, great points across the board. I know we're out of time, but just to take Citizens, its rating profile for the state is I think over 200 territories that are broken out and individually underwritten and risked. And we get this kind of question a lot in Florida, and it just seems to be a fundamental, perhaps dated understanding of how rate making works today. This idea that there's massive cross-subsidization and not actually sound rates. We just reduced the rates for the first time since 2013 in the Tri-County area, Miami-Dade, Broward, and Palm Beach for Citizens on a statewide, in a way that was over 11% average for a lot of those consumers, on top of 100 rate decreases throughout the state with other companies. And it really, I don't see it as a subsidy. I understand we could get to some sort of argument as subsidy if there was an assessment, but to Michael's point, give us an alternative that's different, that would be better, that would also be workable for the future success and financial freedom of people that operate in the state of Florida. And that's.
Thank you, Commissioner. And you're correct. We are essentially out of time. Stephen, Chuck, anything to add here before we wrap up?
Well, I'm just looking at a question that says, should Fair and Beach plans be allowed to issue cat bonds? And I'm sorry to ask or answer another question. They are, and they do. And why do you not see the same relative increased growth in beach and windstorm plans as you do in fair plans in the state-run residual markets from 2019 to 2023? First of all, thank you for asking that question and paying attention to the slides. I really appreciate that. And secondly, because the beach plans are more restrictive than the fair plans in terms of the locations in which they write and also the coverages that they offer. So both of them are diminished because they're not offering the same, even the same coverages that are offered by the plans that don't write a homeowner's policy. They might be writing a wind-only policy, and they might be only doing it in coastal counties.
I'll just finish with, if you don't want subsidies, don't have the government involved in insurance. You can't find a program where there's not subsidies built in once the government gets involved. Let the private market do what they want. You'll avoid as many subsidies as you can. The more we have beach and windstorm plans and fair plans taking market share, the more likely we're going to see subsidies.
Well, it has been a fascinating conversation. It's always good to go back to basics. Today discussing residual property markets. I want to take a moment to thank our audience both on site here in Indianapolis and the folks who've joined us remotely as well. We greatly appreciate the great questions that all folks have submitted. As Jeff Setkowski and Aaron Campbell mentioned at the opening of today's conversation, our Back to Basics series is a quarterly offering. And in the weeks ahead, you'll hear more about what is forthcoming for the next quarter. So we invite you to join us in the months ahead. And we look forward to that. With that, on behalf of the CIPR and the Institute's Griffith Foundation, if you would, let's have a round of applause for our panelists. Dr. Charles Nice, Mr. Stephen Jablonski, Commissioner Mike Conway, Commissioner Mike Yaworski. Gentlemen, thank you very much. It's been great.
Our pleasure.
Thank you.